Hello and welcome to Trading with the Trend. My name is James Boyd. We welcome you here today. Got my good friend Brent Morris in the chat. We also have Luke, Fayez, Jay Richardson, Elena, Rajit, Life in the Fast Lane, and many others. Welcome to all. Let's go ahead and hop right in. Now, this class, we talk about trading the trend. Some of the examples we talk about could be shorter term in nature, maybe just 2 or 3 days to 2 or 3 weeks. Second type of trends we'll talk about is kind of more intermediate, 2 or 3 weeks to 2 or 3 months. That's really our focus on those two kind of types of trends. If you'd like to trade longer than that, then feel free to kind of maybe ask a question on that, but we try to focus really kind of shorter term to more intermediate. Now, also, you can think of that almost, it's more like swing trading, if you will, to more trading the intermediate trend. Just want to give you context. Now, you can find Brent and myself on X. We post educational content there daily. Check that out. You can see our handle there at James Boyd CS, at Brent Moores CS. Just always remember our first letter in our first name and last name is capitalized. We don't solicit anyone. If someone does, it's a James Boyd wannabe. It's a Brent Moores wannabe, okay? And I don't know why some people do that, but they just want to be someone else, I guess. Now, just real quick as we get started, our examples will be stock-based. Occasionally, we will also talk about options. Remember that options carry a high level of risk and are not suitable for all investors. Also, remember when we talk about the information here, it's provided for general informational purposes only. This webcast discusses technical analysis. There's other approaches like fundamental analysis that may assert some different views. And also remember when we talk about examples, we will use the Paper Money software application, and investing involves risk. So really, we want to kind of talk about defining the risk, perhaps. Setting stop losses could be risk in general. What is the risk? So that way we could try to make a decision on how to minimize that potential risk if the investor wanted to. Now, also remember that short options, we're talking about American style options, which can be assigned at any time up to the expiration, regardless of the money amount. We'll also mention the option Greeks as well. And today, what we're going to really talk about is kind of the shorter term pullback that we're seeing in the market so far. I want to kind of talk about how that's playing out so far in terms of stocks in relationship to their moving averages. I also want to bring up maybe a little caller example, selecting strategies in a pullback market, and which might be some stocks that might be getting a little push to the upside in the shorter term pullback. Like what? So we'll bring that up. So first thing what I want to do here is I want to just take a quick look, if you will. Let's go to the VIX real quick. Last Thursday, we spent some time talking about this, and you're going to kind of see if we will look from last week to this week, we've really been starting to really see in the shorter term a crossover to the upside. And if you look at where we were yesterday, that was a decent push yesterday. Now, when you look at where we are here today, did we fade a little bit? Not yet, okay? We actually went right down to the middle of yesterday's range, okay? We didn't go down to it perfectly. That's usually not a great sign, because usually if we have a large candle and the very next day it makes a high, pulls back, but it doesn't go lower than the previous day's midsection of the body of the candle, you can, in the shorter term, you can kind of think about that like a very short-term support area, okay? And if people are maybe buying volatility, they might be thinking the volatility in the market might expand. Volatility is up and down, expansion of the range of movement. And also what that actually means is some investors might be willing to maybe buy puts on some of their positions or the market in general, okay? Now, we want to be, we hit that pretty hard yesterday. I'm restating what we're seeing here. We are seeing that actually happening. There it is. Now, we'll kind of talk about how that's playing out in the portfolio. Now, when you pull up the SP, now, by the way, when you look at the VIX that it's doing that, and we go to the market watch, and I'm going to just pull up the indexes real quick, okay? When we pull up the indexes, it's, when we see the VIX, and I'll highlight that. There's the VIX right there. When the VIX is really in a number 2 trend condition, that's not great. Think of the trend 2 like a diagonal breakout, right? So if that VIX is going higher, it's probably pushing the other areas like SPX, Russell, NASDAQ, Dow. They're probably pushing them down. Dow is actually down a whopping 26 points, but it's in trend 5. Again, trend 5 just means the price is now down below the short-term moving average, which is going to be a theme here. The NASDAQ is in 4, which says it's probably up near an area of resistance. Some people use resistance as a punching bag. Some traders try to use it as an ATM machine to sell, 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 and get their money out of that trend before it pulls back. That's what someone said. I don't say that, but some people think of it like that. The SPX, trend 5, same thing, and the Russell, trend 5. So what we're kind of seeing is when that VIX goes up, the relationship is really the indexes, okay, kind of label it like this, indexes typically down. So in terms of the trend in general, trend, T5, okay, and that just means that the price below the 10. And we can see when we look at the 10-hole column, you know, we're starting to kind of see more red squares there. And we see a red square there. And we see more red square there, and so on. So if I were to, let's say, pull up, let's say, the Dow Jones, in this 10-hole column, there's going to be a lot more stocks that are showing a red moving average line. Now, this begs the question, what does the investor do in that situation? What do they do, right? If we're starting to see more and more stocks in this is the situation that we're in right now. Now what? Okay. Well, this is when the investor is probably saying, look, stops. They're probably actually thinking targets, right? They could actually be thinking also right here. They might say, James, I want a hedge. And by the way, a hedge doesn't have to be a huge position. Okay. It could just be a hedge on the S&P 500. They could also be thinking about cover calls. I'm just going to kind of make a comment. Okay. Some investors are not a fan of covered calls, especially if the volatility is increasing, because when you sell the call, you're negative vega, okay? If an investor could do a covered call, they might say, look, if the volatility is increasing, I'm going to collar the position rather than cover call the position, okay? And lastly, they might do bearish positions, okay? Bear positions. And that could be maybe like a short call vertical, a long put vertical, and so on. But what's the pecking order, right? Number 1 is stops. Number 2 is targets. Number 3 is maybe a hedge. And it could just be on the SPX in general. It doesn't have to be on an individual stock. Usually when I say hedge, we're talking about I'm going to go bearish maybe the S&P, the NASDAQ, the Russell, something like that. Just an index hedge. It's a bearish position, but you got to remember with that hedge, the volatility of the market is typically not as volatile as an individual stock. So you got to remember, as you could say, look, I got a hedge on the SPX or something that's trying to track that, but you got to remember is it's not going to completely offset the stock positions because your stock positions tend to be more volatile, okay? But it's a starting point. And on individual positions the investor has, like cover calls and collars, now you're isolating to that specific stock. I would like to kind of bring up one example of the collar. We brought up a little example of a bearish position yesterday. We'll also talk about that as well, okay? Now, the comment is from Leon. Why not a long put? Well, you can do a long put. In our examples, we tend to try to be like theta neutral, okay? Or let's say something where it actually has a break even that's not as, you don't have to get the stock to drop down as much. Now, if you do a long put, so in our examples, we would do a long put vertical, which has a lesser debit, and then the break even is not as low typically compared to a long put, okay? And the time decay is more neutral. So that's why we do that. We're a little bit more conservative in the examples. But Leon, if you actually said, hey, look, I know the break even's lower, I know the theta is negative. I'm going to go for it. Understand. That's usually we do long put verticals. Now, let's kind of talk about some things here. And what I want to do is I want to bring up an example for just a moment. Let's kind of start with just real quick. Now, by the way, I do want to show one thing. If I pulled up the Dow to show a follow through, if I pulled up the Dow stocks, what we're now going to notice on the Dow stocks is, you know, James, when I look at stocks and how many stocks have a red moving average line on Dow stocks, that's a lot of stocks, okay? A lot of stocks. So in other words, the number of stocks that are kind of in this green condition on the 10-period moving average, there's definitely less and less of them. Now, if the market pulls back more and more and more, there should become less and less and less. And that's why we went kind of through, it's stop adjustments, review your targets, what I just drew. Now, let's kind of imagine the investor says, hey, James, I want to look at maybe a position that maybe is in the paid money portfolio. And by the way, I want to kind of add to that, managing current positions. Now, let's imagine the investor says, you know, James, I have a position and I have a stock example given of ExxonMobil. Now, first off, there are, and I said this yesterday, okay, there are some stocks where the investor says, James, I've owned these stocks for a while. I like to buy some stocks, and I kind of want to buy some companies that I think are kind of maybe monopolies to some degree, that they've been around for a while, and they also have a large representation of what that sector does. Maybe like Apple to technology, maybe like Exxon and Chevron to energy. That does not mean they always go up, okay? But you're saying, look, I want to buy something that if that sector were to increase, there's a good chance that stock might increase. So let's kind of talk about just a quick cover call for just a moment, okay? Now, this is a pretty good example where you say, look, bought the stock at 111 and change, and the stock's at 102. So we're underwater here about $900. Now, what do we got to be careful with? Well, what we got to be careful with is if we did agree to sell a cover call, we're capping the upside, but we also got to be aware of if that stock has dropped down from where we bought it from, we got to be careful which call that we sell. Now, when you sell a call, okay, you have the shares, and then you sell the call, you're agreeing to sell the shares at a set price from now until expiration, not just expiration. At expiration only would be European options. We're not doing those. These are American style options. That means that someone could take the shares of the stock prior to expiration, but they would have to give you all the way up to the strike price, and they'd have to give you all the premium, irregardless if you were at expiration. So it's not all bad. You just have to understand that, hey, someone could take the shares. Now, if we have an obligation, a lot of investors like that obligation to be shorter term in nature. Hence, selling maybe a monthly option, 20 to 50 days to expiration, and trying to sell something out of the money. Now, remember I said one of the challenges, and I know you've never faced this, but sometimes some of us do. If we agree to, let's say, sell something like the 106, what have you just done? Well, you've agreed to sell your shares at a lower strike, which is lower than what you bought the stock for, okay? Now, if the investor was in this situation, they might say, James, I might go to the Julys a little bit farther out, maybe try to sell the 110s. Well, if they sell the 110s and they also get $1, let's say they get $1.50, let's say $1.50 to be even numbers, it's like they're making up to $111.50. Does that make sense? You following where I'm going? If we agree to sell for 110, but we get on top of that $1.50, it's like we made up to $111.50. Now, that would pretty much get us to break even, okay? Now, why does an investor like to go shorter term, something like this? The answer goes back to the theta decay. The options are close to expiration, the time decays faster. It's not saying that these options down here, they don't burn, they're just not burning as fast, okay? Now, what I'm going to do is in this example, is I'm going to click on the 110. And I'm going to go look at this, click on that 110 right there. It's going to give us a premium of, let's say, 151. If we have the shares right there and we sell the call, you're really legging into a covered call. That just means, A, I have the shares already, and number two, I'm going to sell the call. Why? Well, because you actually think that stock is probably more neutralish in nature, and you think that stock might pull back. Okay? So a lot of times when people start to see, and let's kind of say, when might have been a better time to do this in the last couple of days? Well, when that shorter term moving average goes red, the investor is really thinking, look, I think we could pull back here. And if the investors are not going to sell the shares, they might say, look, if that actually goes red, I'm going to sell it. Sell the call. And if that actually, for example, that stock actually goes down again and we start to see the 20-period moving average go red, this is just more confirmation of the pullback. Nothing different than what we talked about, but we're adjusting the position. What do you mean adjusting the position? Well, if you have 100 shares of stock, 100 delta, you sell the call, it's lowering the delta on the overall position. What do you mean overall position? Well, when you have shares of stock, 100 delta, you sell the call. If we sold this call right now and said, okay, this is what we're going to do, okay? If we did that, let's find that paper trade. If we sold that call right there, notice the credit less the commission, net credit. If we did this together, now notice we have 100 shares of stock, 100 delta. But when we sell the call, it's negative 26 delta. Selling the call itself is not a bullish position. It's a bearish position. Buying a call, that's a bullish position, positive delta. Selling the call, negative delta. Okay? So when you combine these two, the shares and the call, what it gets us to is a delta of 73. When you go take the delta from 100 to 73, you're trying to lower the directional sensitivity to the drop in the price of the stock. Okay? Now what's the risk of the covered call? Volatility increasing. Okay? Second, what's the risk of the covered call? The stock actually dropping down severely. What's another risk of this trade? Well, I'm not sure if I'd say a risk, but there's a cap on the trade at 110. Okay? Now, yeah, so now Josh actually says, I want to go back to this chart so I can show this for just a second, okay? And I want you to really look at this timing. I'm going to write this down so we're crystal clear. The investor, now remember, simply put, when that 10-period moving average is green, 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 this is when they're trying to have a higher delta. Okay, and I'm going to point to this. That investor is probably going to say, James, I would like to have a higher delta. Why? Well, and what does a higher delta mean? They're trying to pick a strategy, which could include stocks, that if they got the direction right, they could benefit. If all of a sudden that we get the red line there, the investor might say, James, I'm going to alter the position by doing a cover call, which we just did. James, could I at the same moment say, look, I'm not going to do a cover call. I'm going to collar the position. Sure, the entries would be the absolute same. And so would the exits. Okay, same. Now, I said to you before, now here's the thing. I've looked at this for 25 years. I used to think that, oh yeah, I'm going to sell a call, and if it pulls back, you know, the cover call is really going to be helpful. It can be helpful as long as the volatility stays lower. The higher the volatility goes in the market, the more premium that you don't really realize, okay? That time decay that you thought you were going to get is being offset by the rise in volatility. That's why understanding the caller is really important, okay, compared to a cover call. Now, speaking of that, okay, let's say the investor said, okay, James, I want to kind of take a look at a practice example. Could we look at maybe doing one on, now I'm going to go NEM, for example, given, okay? So I'm going to kind of bait you into something. And this is a little fun for me, but I don't mean it bad. Let's imagine a friend calls you up and says, James, I got a stock NEM, and NEM I think is a perfect time to do a collar. Sounds good, okay? 100 shares of stock. the market's going to fall apart. I just watched TV and they said the whole world's coming to an end. And this is really what goes on out there, okay? The investor says this is a great time to do a collar, protect the position. Is it a good time? Is it a good time to actually put on a collar? So you got to think of it individually, okay? So when you go look at this position, I'm going to kind of say, oh, look, this is a perfect time to do a collar position. We had a high, we had a lower high, and then what you're going to notice is, oh, now I'm going to draw my line like this, okay? So all of a sudden now is when we didn't have this kind of, when we were about right there, the diagonal line was right there. But now all of a sudden we lift this up and say, so I can feel better about putting on the bear's position. Now I'm going to draw the line where I'm not touching the bodies of the candles as many as possible. Now I'm going to draw the line to validate my emotions. Really? Okay. Now, so if that stock was, let's say, quote, breaking out, a diagonal breakout, and we got to ask ourselves, NEM is what? It's a gold stock. And NEM is correlated to the basic materials, it's correlated to the S&P, it's correlated to the gold price. And if we're seeing the volatility in the market go up, where does the gold tend to go? Well, gold tends to go up too. Now, could that gold price going up translate to potentially some NEM going up? And the answer could be yes. Now, so let's kind of say that on NEM, look, we're thinking it could be bullish, and I'm not going to do a collar because I see it a diagonal breakout. You could really say that this is really like a bull flag. If you're doing a breakout, why on earth would someone do a collar on a diagonal breakout or a horizontal breakout? Doesn't really make a whole lot of sense because that's like a bullish trade. When you have a bounce, when you have a breakout, that's when the investor is trying to have higher delta because they think the stock can go in the intended direction and it has momentum. Now, let's kind of imagine, okay, fine, great, that's all great and dandy, but James, I'm concerned about this, I'm concerned about that, I'm concerned about this, I'm concerned about that, whatever, okay? Can you have pending protection? Could you say, look, if this fell down, can I have pending protection below? See, some investors set stops. And some other investors, they actually have pending protection. Now, if I said to you, I don't use stops, does that mean it's good for you? No, okay? You don't know what I do, and I don't know what you do, okay? Wonder if I told you, hypothetically, that I like to do pending callers, and you like to set stops. Does that mean it's appropriate for you? No, you don't know what I know, and I don't know what you know. So the thing is we all kind of look at it maybe a little differently, but you get to choose what you want to do. Let's say we choose to have pending protection. Now, all I'm going to do on this is I'm going to kind of play the game with little JP here. And let's say I said, hey, if we said a stock investor is setting a stop, the stock investor, okay, stock investor says if we go below $51, okay, have a stop. Okay, fine. The option investor that does stock and let's say options, they actually say if we go below 51, trigger protection. And I'm really saying option protection. Now, if we said what is one of the most, like a very important strategy that we need to really know if we have 100 shares of stock, we would definitely practice in the paper money account a collar. Now, so what we want to be thinking about is something very simple. So if the stock goes below 51, what short call strike is above 51? Now, I don't need to tell you that. I mean, you know basic math. What long put strike is below 51? Okay, so let's say hypothetically, the stock drops down. The stock investor says, look, I got my stop and I got stopped out. They realize the loss. Okay, so that's the risk with the stop loss. If you go down to even there for a split second, okay, and it fills, realizes the losses. That's why some people don't like stops, okay? Now, if the investor says, hey, James, I'm going to use options, there's pros and cons of each, and we're explaining that. we're going to say, look, if it goes down to 51, trigger the option protection. Well, how do I know which call to pick? How do I know which put to pick? Well, we're going to go out that 20 to 50 days. And then what we're going to do is we're going to pick the call that would be above the 51 price level. And then what long put strike is below the 51. Well, that's really not too bad. Without even looking at the table, we know we're going to probably be looking at the 52, the 53, the 54, the 55, without even looking at the option table. Okay? Basic math here. Now, here's the deal. What long put strike is below 51? Well, we know we're going to probably be looking at the 50, the 49, the 47, and so on. It's not that complicated. Okay? Now, why is that? Well, because on a short call, you're trying to sell out of the money calls. That's why the strike is above the price. Why are we trying to actually buy a long put strike below the 51? Because when you buy the long puts, you're typically buying puts that are out of the money. That's all it is. Okay? Now, let's do this. We're going to go to the trade tab. How long does this really take? Well, what we're going to do is we're going to come to this page and we're going to say, look, got the shares of the stock. Okay? Got the shares of the stock. Let's go back to the NEM. So here it is, got the shares. Okay? We're going to try to let the stock go to the upside, but I just want to make sure that I'm prepared. That if this stock starts breaking down, or maybe I'm not going to be here, I want to have some option protection pending. So what we're going to do is going to go 20 to 50 days to expiration. And we're going to go look. Now, remember we said, okay, if the stock falls down to 51, what would be the call strike above 51 if the stock went to $51? Well, you got the 52, you got the 52 and a half, you got the 53, right? Well, so if I said, you know what, I'm going to pick the one that's a little bit more, has more open interest, tighter bid-ask spread, etc., probably going to pick the 52 and a half. So if you have the shares already, how do you pen a call or position? Well, right click, right on the call you want to sell, and then we're going to go right to where it says caller, okay? Now, if the investor did that, we picked the out of the money. We're saying if the stock fell to 51, what would be the strikes on the call side above that? 52, 52 and a half, 53. Okay, there it is. Now, what about the put side? If the stock falls to 51, what would be the strikes below that? Well, 50, 49 and a half, 49, and so on. Now, if I said which one has more open interest, tighter bid-ask spread, it's really the 50. Now, what you're going to notice is we're actually going to look to sell the 52 and a half, buy the 50. Now, we're going to go over here to the limit to the market, day to the GTC, okay? And what we're going to do is we're going to say, just like we've been saying, we're going to click on that gear, and we're going to say only put on the protection if the stock does what? Fill in the blank. Only if the stock does what? All right, now notice here when I do this, if NEM, the stock price, is below the 51. Now, guys and gals, I'm telling you, this is super important. If you're not really paying attention here, in the future, you're probably going to regret it, okay? If someone says, I don't really know how, so we talk about setting stops. Second part of that, what's an alternative to that if the investor considered options? Pending caller positions. And this is where people say, well, it's confusing. It's hard for me to think. Look, we all went to college. This is the simplest thing that we've actually learned in terms of like, okay, we're going to use the exact same thing we learned with stops. Where would you exit the stock position if you were in the stock position? That's why we use 51. So then we need to think, well, if it goes to 51, what's the call above? And if it goes to 51, what's the long put strike below? Because they're out of the money on both sides. Now, if we did that, we're going to go save, confirm, and send. This is a GTC order. Confirm, send. Now, so what happens if the stock goes up? Well, the investor just still has the stock position. Okay? Now, is this something the investor might have indefinitely? Well, you can't say indefinitely because this has an expiration of the 20th of June. Probably on a weekly basis, they would look at this and say, hey, is that support level still the same support level? And maybe if it's not, they might alter the expiration and the strikes. So the stop investor adjusts the stops by adjusting the stop price, where the option protection person, they're actually saying, where do we see support and how long, what's my current protection? Am I running out of time? If they are, they probably push this out to July, and they also just adjust the strikes. But really, honestly, not that bad. You do this over and over and over and over. I mean, now, the nice thing about this is, so now if the investor says, yeah, I'm concerned about the market, there's some crazy stuff going on out there, whatever that means, okay? If this stock goes to the upside, they have not capped the upside, okay? And if that stock goes down to $51, they have not sold the stock price. I should say this, excuse me. They have not sold the stock. They've agreed to sell the shares at 52.5, and they have the right to sell the shares at the, let's go back. They have a right to sell the shares at 50. And guys and gals, that's a beautiful thing because really if this stock goes down, they have the right to sell the shares at 50. What happens if it goes to 45? What about 40? Give me a 35. Give me 30. It doesn't really matter. They have a right to sell their shares at 50. What's the con of the trade? Could be a debit. What's the con of the trade? You cap out the upside. But remember we said yesterday, which people say this, but do they really believe it? The number one job is to not profit first. The number one job is to protect the capital, the king or queen, okay? Now, comment from Asthma. Could we do a collar with the same? My gosh, I wanted to go there. Okay. Now let's throw this out here. I love this question. I'd pull my hair if I had more hair to pull. Now here's the deal. I love this question so much. Why would someone, so first off, why does someone do differentiation of strikes? Why do they do that? Simple answer. Okay. If we actually, for example, sold, let's look at the 52. So when we talk about, if we have 100 shares of stock, and this is such a good question. Oh my gosh. It's like eating a little slice of cake with some ice cream right here. 100 shares of stock, right? 100 delta. All right. So here we go. Beautiful question. I can't wait to get to the bottom. Now, here we go. If we sell a call, and I'm just going to sell call. I'll just put sell C. Normally, if we sell out of the money, it's going to be probably a delta of, let's say, negative 30 to 40. Okay. And if we buy a call, buy a put, typically if we do out of the money, it's delta of 30 to 40. For simple math, let's just say we sold the call with a 35, we bought the put with a 35, and you said, okay, what's the delta now? Well, if this was 35 negative, this was 35 negative, the caller would have a delta of about 30 plus still. 100 shares of stock, 100 delta. Selling the call, negative delta. Buying the put, negative delta. And what you're now going to see is it's still going to give us a positive delta. But why would someone do the exact same strikes? Well, if you do the exact same strikes, what it does is it makes it where it pushes down the delta even lower, and the delta on the position really is zero. Now, James, have you looked at that? You better believe I have, okay? Why would someone make a position where it's so, and let's just kind of show this, okay? Let's look at a practical application here, okay? Now, this is mind-blowing because, so if someone has like an asset, let's say 100 shares of stock, and if you don't mind, what I'm going to do is I'm going to try to find, let's imagine that we had a stock position. And what I'm going to do is, let's say the investor says, look, I got shares of Wells Fargo, but I'm becoming very concerned about the potential drop. Maybe there's some things upcoming in the market that, let's say it could be a presidential election. It could be earnings itself. It could be regulation that could hurt the business and so on. Let's imagine the investor said, look, I have 100 shares of stock, okay? 100 shares of stock. Confirm send. They have the shares of stock, okay? Now, if they have 100 shares of the stock, and I just want to make sure we get filled here, they have 100 shares of the stock. Now, I'm just going to do a market order so we try to get filled as soon as possible. If we sold like in the 74, and let's say we bought the 75, then what that's really going to do is it's going to make the delta zero. Now, this is mind-blowing because if the stock were to decline, it's the stock that is losing, but the options are offsetting the losses, okay? Or should be. Sell the call at 74, buy the 74 put, and it's with a little bit of a debit. Not a ton, okay? Not a ton. Confirm send the order. Now look and see what happens. Watch the delta right there, okay? Now, have you ever been in a situation where you were concerned about your positions? That you had a number of positions you were concerned about, and you were concerned about your portfolio, but did not want to sell. What do some people do that have experience? They say, look, I'm going to kind of lock up my positions, or I'm on vacation. I'm on a cruise ship, and I'm not even going to be close. And I don't want to pay $75 a day for Wi-Fi on a boat because I want to enjoy my vacation. I just want to hold my positions. If they go to the upside, I'm capped. I understand that. But really what I want to do is buy myself some potential time. There is risk of someone taking my shares. But overall is the delta is zero. If you have a delta close to zero, what does that mean? That really means that you're not directional, okay? You're flat the position. Flat the position means the stock goes up, you don't participate. If the stock actually goes down, you don't really lose because the investor has the right to sell the shares at 74, okay? That long put should be offsetting, the short call and the long put should be offsetting the loss in the stock position. Now, we could see this a little bit more, okay? If I go to analyze the trade, put this on the risk profile, what I'm going to do is kind of throw this up here. Now, I'm going to tell you something, and I'm just going to be look, just tell it the way it is. There's a lot of people that know about a lot of strategies, but probably have never really traded them, okay, in real life. This is something when we talk about stops versus option protection, you want to be aware when the investor might consider using one versus the other. Stops tend to work fairly decent when there's volatility that's contracting or dropping down. Stops tend to, they tend to work, but when they get triggered, it's when the volatility is low and increasing, okay? And so, yeah, they work, but they could lock in losses or give back some potential profits, and among other things. If I analyze this trade, now what we're going to see on this, and let me just kind of make sure we got that. Yep. And let me actually just kind of set that up. WFC. I want to kind of just show this. That graph is not showing. I want to see something real quick. Let me unlock that. Okay, stock position. Let me unlock that. Okay, so there's our stock position, right? Diagonal line. If I add that, okay, so what's going to happen is if you're going to see that this blue line is flat. Why is the blue line flat? So this is where the current stock price is right here. How come it's not like the typical line we normally see? Well, because if the stock actually goes down, you don't really have a loss. If the stock actually goes up, we don't really have a gain. It's flat. So if you choose to do the exact same strikes, now, if I mix this up and said, wonder if I did a kind of more like the ones we talked about, like a 72.5. Wonder if I sold the 75. Notice how that blue line is your typical, like that represents the cap because you agreed to sell the call. This represents the long put, the right to sell. This is what you normally see, okay? But if you change them, 74 on the put, that blue line goes flat. So now if the market crashed 10%, and now the investor says, man, I got worked over. Well, the puts would probably become worth a lot. The call might be, depending upon how much the volatility hurt that call to push up the premiums. But overall, the stock was protected, okay? And so, the con about the caller is the protection does not go indefinitely. It's only until expiration. Now, Josh actually says, JB, on the same strike caller, how far out? Well, it can kind of be event dependent. How far out is the event? Presidential election. How far out is the earnings? How far out is maybe the regulation? Maybe they're actually getting sued in court. You know about that. You're concerned about that. You want to protect the asset, the underlying shares, and so on. So how far out might be dependent upon when are the earnings, okay? If we're talking about just kind of a standard starting point, 20 to 50 days, that might be extended perhaps or shortened based upon when is the event that you're concerned about. All right. Any other questions? All right, good. Now, guys and gals, what I really like about our conversation, now we're starting to think like investors. It's not just putting something in. It's actually saying, okay, if I don't like what the market is showing, how can I change the delta on the position? And that delta is just kind of, if we lower the delta, we want to make the position less sensitive to direction. Why? Well, it's because it's how we started. If we're starting to see price down below the 10-day moving averages, we're in shorter term pullbacks, okay? So that's very important. I love this because this tells me now we're thinking. Now we're starting to really think like an investor, not just buying a little stock, hope I make a little money. Look, you got to think about up and down and sideways, okay? Now, yeah, so probability trader says we are bearish because the VIX is up. So let me ask you a quick question. Probability trader, when have you tended to give back or lose money in the market? Was it when the VIX was up and falling? Was it when the VIX was low and increasing? When was it, probability trader? I mean, when the VIX was down here and rising, was that bullish investor just making money hand over fist? Ah, that's funny. Okay. Now, if the investor said, no, James, I mean, what they're going to probably tell you if they're just being brutally honest, James, when my bullish positions, I tend to be better off perhaps when the VIX is high and falling down. That's when I tend to be more bullish. When the VIX is rising, there tends to be more of a correlation of stocks that are falling down below support levels, making lower lows and potential lower highs. And that's why the investor is talking about protection, stop adjustments, and so on. All right. Okay, good. Yeah, Wiley says, glad JB is not emotional. I'm not emotional. I always joke with my wife, how come we're the only normal persons that we know? And it's a joke, okay? And it's like, if we're using ourselves as the base case, we're in deep trouble. Okay, little fun there, little fun. All right, now, I want to kind of go back to a couple positions we're going to keep an eye on. So first off, one of the stocks that, for example, has gotten a little push that is still hanging up there is Tesla. Now, I want to kind of make this comment. A lot of these stocks like a Tesla, like a Meta, what's been a little unusual about Meta, and I want to finish with this one, okay? So this has been a stock where, yeah, it's gone down, and I can see it, okay? So we see the red line in the moving average, we see the red line in the moving average, and we see the stock below. Now, what's a little bit unusual about this is, when we've dropped in the last 5 days, there's no red candles. Why not? Well, when the stock drops, someone's trying to buy on the dips or institutions. And this could be kind of making a new potential support level. Now, let's kind of also think here. If we said, well, James, I'm looking at a stock like Meta and Tesla, I'm using both these as a proxy, that where they ran up and they pulled back, and the pullback might be trying to make like a higher level support, what might the investor do? Answer, buy stop orders. Number two, the order to get in would be conditional upon the price getting at or above. A buy stop order is a stock order. If we did like a long call vertical or short put vertical, but made it conditional on the stock getting at or above a certain price, well, that's what the option trader is doing. Speaking of that. So if we said, James, what would I need to see to really say, look, I'm going to consider a bullish entry? They might say, James, I want to at least get halfway in between the moving average to think that maybe this is pushing to the upside. Now, I'm going to finish this fast. But if we said, hey, look, I'm going to sell in this case, I'm going to sell the 630, and what I'm going to do is I'm going to buy the 625. But I don't want to do that until we get at or above the price of conditional order. So when you're in a pullback, you're trying to pick your spots because you've been technically trained to read breakout levels and bounce levels. And now we're just executing what we've learned. We're saying, look, if that stock gets above 645, this could be that we're getting above the 10-day period moving average, and we could be trying to get back up above resistance. Now, so what I want you to do is kind of keep in mind of what we talked about here today. Cover collaring, why would someone consider the differences? We talked about with the collar, picking kind of more standard strikes and expiration. Great question we actually had was regarding why would an investor pick the same strikes? And last but not least, kind of also brought up some points of why would an investor maybe be considering maybe even doing some positions with pending orders, like a buy stop or like on these on options, and they're picking the entry prices to trigger their order for entry. That's really important in where the market is as well. Now, I'm out of my time here today. I want to thank Brent Morris for answering the questions in chat. Stay tuned for our next webcast coming up right at the top of the hour. Join Brent also for his class on advanced options tomorrow. Ben and I will be doing the ETF class tomorrow morning. And with that said, remember that all investing involves risk. And this has been the class on Trading the Trend. Thanks so much. Take care. Bye-bye.